welcome to all our viewers. You're watching our special initiative for her, an initiative by ICICIdirect where we focus on women who know how to take care of their financial well-being. I am Priyanka Uppal and I have a very special guest today with me. I have Anagha Deodhar from Chief Economist from ICICI Security. I am sure this is not going to be the first time you've been asked for this question, a repeated question, but a very important question. Why is personal finance so important, and especially for women?
Yes, absolutely. So, see, financial planning is important for everyone because what is happening is currently we're living in very uncertain times. You must have seen last year there was a COVID related lockdown in the second quarter of the calendar year. And what happened was economic activity sort of came to a grinding halt, at least during the months of hard lockdown, so to say. And this led to companies not making enough revenue to pay their employees, and as a result of that, there were big job losses, especially in the informal sector. And this led to a lot of people losing their jobs, a lot of people losing their income completely. Similarly, a lot of people also had to take pay cuts. So their incomes in 2020 were lower than what they were in the preceding year. And this was an unforeseen or unpredicted situation for many people. And although COVID was, say, an unusual or once in a lifetime event, episodes of increased uncertainty have become more common in our times, especially if you talk about the private sector. Your job security is as good as your last appraisal, so you have to constantly perform well to keep your jobs, and it's a increasingly competitive world out there, because of which you cannot take anything for granted. You cannot take it for granted that you will have a job in the medium to long term. You cannot take it for granted that your income will increase by a certain percentage every year. So that makes planning for the future that much more difficult, and hence it's very important to have a good financial plan in place so that you derive maximum benefits out of the resources that you have. And I would say financial planning is more important for women, because in India what we are witnessing now is you have this entire generation of women who have great education, who have great jobs, and they're doing very well in their lives, in their careers, and they're making a lot of money. And women typically have relatively less knowledge of financial instruments and capital markets. So it's very important for them to know what to do with the resources that they have, what to do with so much money that they're making, and how to efficiently use this money so that all their life objectives and all their life plans, the goals, are catered to or are taken care of in the most efficient, most effective manner.
Absolutely. So, if you have to just list down what are the basic thumb rules of personal finance?
So, the basic thumb rules of finance, in my opinion, would be a certain set of guidelines that decide how you're going to spend your money. So, the first and the most important guideline, in my opinion, is saving before spending. What most people typically tend to do is, when they get their income in the beginning of the month, they meet all their expenses of the month first, and whatever is left after meeting expenditure becomes their saving. But I think that's a very inappropriate way of handling personal finances. Instead, it should be saving first and spending later. So you decide how much money you want to save every month based on your life goals, based on how much money you would like to have at the end of your working life, the saving nest egg you would like to have at the end of your working life. And once you decide how much money you need to save every month, you put that money aside first, and whatever is left after saving should become your expenditure budget. So instead of spending first and saving later, it should be saving first and spending later. So there is a very important thumb rule for personal finance which I think everybody should follow, and that is the 50-30-20 thumb rule. So what this thumb rule says is, if you have any fixed expenditure every month, or any fixed cost that you need to meet every month, and this could be your either rent, or this could be your housing loan EMI, or if you have any other loans that if you've taken, the EMIs on these loans, these are your fixed costs. And these costs should not be more than 50% of your monthly take home income. And this is the first rule. The second rule is the 30% rule, and this rule says that you should save at least 30% of your income every month. So that's almost one third of your monthly income every month. And the remaining 20%, that is the money that is left after meeting your fixed expenditure and after saving one third of your income. What is left, the 20%, is the amount of money you should spend on discretionary consumption. And this discretionary consumption could be shopping, or this could be taking a vacation, or it could be expenditure on entertainment, leisure, whatever it is. That should not be more than 20% of your monthly take home income. So the 50/30/20 rule is at maximum of 50% of your total income goes towards fixed costs, which is all the EMIs and the rent and everything. 30% goes towards saving, and 20% goes towards discretionary consumption. And I think if you follow this rule, you will automatically have, over a period of time, you will have a good saving amount in your kitty. And you will also have taken care of your loans and other fixed costs that you have to meet every month. So this is a very important rule that I think everybody should follow. The second thing I would like to highlight here is people who have recurring big ticket expenditure. So, for some people, this could be a tax liability which occurs a few times during the year, or for some people, this could be children's education and a lump sum payment that they have to make towards children's education, which happens every year. Or it could be any other liability that you have to meet, or any other big ticket expenditure that you have to pay for during the year. I think recurring deposits is a good instrument. So you should set aside a fixed amount of money to in that recurring deposit every month. And at the end of the maturity, when you're actually supposed to meet that expenditure, everything is provided for. You have that money ready. So this is a very good financial instrument. And I think the thumb rule again would be to have, not to let any exigency or not to let any unforeseen emergency derail your financial planning. So from this perspective, having insurance is a very important thing. Insurance products are very important for financial planning, so that your financial planning is on track and you are paying, or you're putting aside a certain amount of money every month to meet those goals. And if something unforeseen or something unexpected happens, that should not completely jeopardize, or that should not completely derail your plans. So from this perspective, health insurance is a very good instrument to have, not just for yourself but also for your dependents. And these are some of the things everyone should follow in case of to meet your financial planning goals most in a most efficient manner.
So yes, you spoke very rightly that you need to choose the right instrument. So if I say that, how to prepare yourself, how to plan for yourself. So every individual have different goals. Every individual will have different priorities. How to prepare, plan financing these goals.
How should you plan for different life goals? A very important and very relevant point for all of us, and I would say particularly for women. So, I think the first thing you have to take care of, or the first thing you have to sort out, is what are your life goals? What is it that you want to achieve in terms of your investments, in terms of expenditure, in terms of how you want to deal with your finances? What is it that you want to do? So one first you have to set the objectives right, you have to set the goals right, and then you can start planning for to start planning towards those goals. So I think these things depend on a lot of factors. For example, your age, your background, the number of dependents you have, and your unique circumstances. So, for someone who is very young, who has just started working, maybe a 25-year-old person who has just started working and just started earning money, the goal could be taking a nice vacation to an exotic place. For someone who's a little bit older, maybe in their mid 30s, and who's newly married, the goal could be buying a house. For someone who's slightly much older, say in early 40s or mid 40s, the goal could be paying for your children's education abroad. And for for fast forward a little more, and people who are closer to retirement, their goal could be having a comfortable post retirement life. So depending on where you are in the life cycle and your unique circumstances in terms of the number of dependents and other financial liabilities that you have, the goals could be different. And if I'm typically talking about a person who's in their mid 30s, and now they want to start planning buying a house or planning for their children's education, what they need to keep in mind is, by when do you expect to achieve this goal, or by when is this liability like to occur, and how much you need to save right now so that you can comfortably pay for this expenditure when it arises. So if I want to buy a house 2 or 3 years from now, and the cost of the house is a certain amount, x rupees, and you also have to account for inflation, because the cost of money or the purchasing power of money is not going to be unchanged during this period of time. So or if you're talking about your children's education, so 10 years from now you want to send your child abroad or to an expensive university in India, and the cost of the education right now is 10 lakhs or 12 lakhs, and 10 years from now it's going to be much higher based on the inflation rate that you assume. So how much money you'll need when that liability arises, or when you're supposed to meet that goal, you need to keep that in mind. Calculate that amount, and every month start putting aside some money towards that goal. So, firstly, defining goals. What is it that you want to achieve? What is it that you want to, gain from your spend, or how you want to utilize your money? That is the first step. The second step is realizing when that liability is like to, or estimating when that liability is likely to arise, and how much will that money be, in that year, how much is likely to be the expenditure in that year when the liability arises, and to meet that, how much money you need to put aside right now. So this is important for achieving your life goals in a very efficient manner.
Sure. And in between all this, how to plan for your urgent needs, or any emergency, or in short, I'll say exigencies.
Yeah, so planning for exigencies is another very important area that that forms the core of financial planning. Like I said, you have a financial plan in place, and put aside a certain amount of money every month, and everything is going as per the plan. And it shouldn't happen that one emergency or one unforeseen situation, or an exigency completely derails your financial plan or completely takes you off course. So like I said, these emergencies are becoming more and more common because we live in a very uncertain world, and hence it's very important for us to protect our investment plan from these emergencies. So the first important instrument, in my opinion, for tackling emergencies would be insurance, and it could be life insurance, or it could be term insurance, or it could also be loan insurance. So life insurance, in case something happens to you, make sure that your dependents or other people in your family member don't face the brunt of the sudden income loss that is associated with such an eventuality. So it also has an investment portion. So at the end of when the insurance plan matures, even if nothing happens during the course of it, you still get a good nest egg of investments. So that is a very good in financial instrument. The second instrument, very interesting instrument, is term plans. So if you would rather just buy the cover and you don't want an investment portion, you can just buy the cover. The premiums are lower on term plan insurance, and the surplus money that is left, you can as against a life insurance plan, you can invest that money. If you understand the capital markets well, you can invest it yourself, and probably get higher returns on your investments compared to a life insurance. So life insurance along with protection also gives you an investment portion, and term insurance gives you only protection but no investment portion. So depending on your understanding on your and your knowledge of different financial instruments, you can choose what works for you. The third instrument I want to cover here is loan insurance. So, people who have liabilities such as a housing loan, If something happens to the primary borrower during the course of the loan, housing loans are typically long tenure loans, 15 to 20 years. So if something happens to the primary borrower during the course of the loan, you can buy loan insurance which will make sure that in such an eventuality the loan will be waived off by the bank and the burden won't fall on the surviving family members. So this is another very good way of protecting your family and your dependents in case something happens to you. So another important instrument which I think people who have long-term liabilities or long-term loans should definitely consider and definitely buy. So this forms the first line of defense against emergencies and against rainy days. And the second line of defense would be, like I said in the beginning, that having a good savings portfolio, having a good savings nest egg. I said that in the beginning I said that you should set aside 30% or one third of your monthly take home income in terms of savings, and over a period of time this will become a sizable amount. And eventualities such as job losses, or if you're unemployed for a very long period of time, or if there is any unforeseen emergency in the house, then this savings that you have accumulated over a period of time will come in handy. And the third thing I want to point out is, make sure that a good part of your investment portfolio is liquid. By liquid I mean the ability to convert this into cash quickly. So something like real estate is not a very liquid investment because it takes a long time to convert real estate into cash. But on the contrary, something like mutual fund is a relatively liquid investment because you can quickly sell it and raise money. So having a good part of your portfolio in the form of liquid assets is also a very important step for protecting your family and protecting your dependents against emergencies. And about the insurance part, make sure that you have insurance not just for yourself but also for people who are dependent on you. And this I'm talking particularly about health insurance, because if health insurance, if you are expected to pay, or if you pay for your dependents and your family's healthcare needs, then you also need to make sure that if something happens to you, something happens to them, you won't have to spend that money from your own pocket, and that is covered under health insurance for your near and dear ones. So insurance, life insurance, health insurance and loan insurance forms the first line of defense. The second line of defense would be your savings that you have accumulated over the years. And the third line of defense would be the investment portfolio that you have, in terms of, it could be either mutual funds, or investments in stocks or in real estate. Make sure that a good part of this is liquid, in the liquid form, which can be converted into cash quickly. And this will protect your family and your household from unforeseen events or unforeseen financial emergencies.
Sure, absolutely. Thank you so much for guiding us. But one more important question that viewers are very keen to understand is how to plan their retirement.
So I'm glad you asked me this question on retirement, because I think this is one of the most ignored and one of the most overlooked part of investment strategies. Most people tend to think that I'm still very young, I'm still working, and I don't need to start planning for retirement so early. When it comes to that, we'll see it, or we'll cross the bridge when it comes to that. But I think that's a little laid back or a little irresponsible approach towards retirement planning, because what we need to understand is life expectancy is increasing. It has increased significantly in India, especially for the urban high income class. Life expectancy has increased, because of which you are expected to live longer, much longer after your retirement. So if you retire at the age of say 60, you'll live for at least a couple of decades after you retire. And this is why it's very critical to have a good retirement plan in place, because what you need to understand is, to maintain the same lifestyle that you had when you retire, you need to have a sizable amount of savings for your retirement. So if a person is making say 50 lakhs per annum when he or she retires, and if that person is expected to live for 20-25 years post retirement, then the amount of money they need to have is 50 lakhs into 20 or 25, and that's a big amount, that's a sizable amount. And the value or the purchasing power of this money won't remain constant, because you'll also have inflation. So assuming an inflation rate of 5 to 6%, the value of this money will decline by 5 to 6% every year. And hence, the money you need to set aside for your retirement is not just your income in the year in which you retire into the number of years you're expected to live, but you also need to adjust that for inflation. So this is a big financial need. This is a big plan, and for which you need to start working, or start working towards this goal as early as you can in your life. So don't delay it till you are closer to retirement, because then you won't have enough time to save for your retirement life. And as you get older, your healthcare expenditure is going to increase. So you also need to make sure that you have health insurance in place for yourself, for your spouse, and for your dependents, so that in case of increasing healthcare expenditure in your retired post retirement life, the burden doesn't fall on your revenue sources of revenue, or the burden doesn't fall on the money you have accumulated for your retirement, but that burden is taken care of by the insurance plan. So this is one thing I would like to highlight, that health insurance is very important for any retirement plan. And the second thing is, start as early as you can. You estimate your needs properly and start early as you can, and don't delay it till you're closer to retirement. The third thing I would like to highlight here is, if you build any fixed asset during your working life. For example, if you buy 2 or 3 houses during your working time, you can monetize one of the assets, or you can start getting a steady stream of revenue from one of these fixed assets in your post-retirement life. This could mean rental income from one of your houses, or this could mean some fixed income that you get from your revenue stream, from your fixed assets in your post-retirement life, that will give some sort of stability to your revenue or your cash flow in the post-retirement life. So these are some of the important instruments. You also have another instrument called reverse mortgage, which is relatively new and relatively unpopular. Not unpopular, I would say relatively little is known about it in the Indian context. So reverse mortgage is also a very good retirement instrument. It ensures that for your post working life, you get a certain amount of money on a regular basis for as long as you live, and in exchange you may just have to sacrifice one of your fixed assets, but at least your needs are taken care of. So this is again gaining a lot of popularity, especially in the context that now we have nuclear families, and the intergenerational uh, responsibilities have sort of it's falling out of flavor. So in this context, reverse mortgages have also become popular, gaining more popularity. So these are 2 or 3 instruments that to keep in mind when you're planning for post-retirement life.
Sure, got that. Thank you so much for your valuable time and thank you for giving all such insight. Thanks a lot for joining us today.